Welcome back. Our next guest suggests taking a balanced approach among different sectors of the equity market when you make your portfolio choices this year. He sees opportunities in the industrials, basic materials, semiconductors, utilities, and consumer sectors. For more, let's speak with Aaron Dunn. He's co-head of value equity and a portfolio manager at Eaton Vance. Aaron, thanks a lot for joining us. That's a long list of sectors that you're bullish on. Are you broadly bullish on U.S. stock markets for 2024?
Yeah, actually, we are pretty positive on the market next year, but I think it's going to be a different market. I think this year was very much a year of the top-heavy sort of Magnificent Seven. A market cap-weighted index did extremely well this year, and what you saw underneath the surface there was not a lot of great things happen in the market this year. And so, in our view, next year you're probably going to see that broaden out. And what makes that happen is, a little better sort of outlook for the economy, I think, as the year progresses. And I think we're seeing that today. Also, the valuation is attractive underneath the market in a lot of sectors that really were impacted last year by a number of issues. So we think there's a broader opportunity out there rather than, a market cap weighted index. And when we talk diversification, we're talking style diversification, value versus growth as well. And we're also talking about diversification across the portfolio and not being too concentrated.
You like consumer goods companies. Do you think they will do well this year? Why so?
So I think 2023 was an interesting year as it relates to a couple issues. One was the GLP-1 phenomenon, which has really taken hold, and the uptake of that product from its producers has been fantastic, and they're actually constrained on a manufacturing basis. But I think embedded in these stocks has been this view that food demand was going to go down. Also, I think there has been a pricing overhang in the food sector, kind of consumer sector, because of the COVID absence now and sort of the overlap of inflation coming down in some of their inputs. And also, I think you're going to see a volume, and we're seeing a little bit of this today with General Mills, which is some consumer trade down. And so I think the market's been really worried about that all year as consumer balance sheets have contracted a little bit, right? So the consumer's not in as good of shape. Inflation is real. Everyone feels that, and they feel that when they go shopping. So they're trading down. So there has been pressure on these stocks all year. We think that creates opportunity to own some really good businesses. And, we're opportunistic value. So when we look at a lot of these companies like Hershey, for instance, that have really been beat up this year, Hershey has a couple other issues with cocoa prices, for instance, but it looks extremely attractive to us. This is a fantastic return on a capital business, fantastic balance sheet. They'll keep pricing over time. Eventually, margins are going to recover, and the stock should continue moving upward in our view over time.
In the industrials, one stock you like is Westinghouse Air Brake Technologies, ticker symbol WAB in New York.
Yeah, this is a fascinating one. This is part of the old GE transportation business, and they make the locomotives. And prior to 2015, we were probably putting 500 new locomotives in service a year in the United States, and that is really was cut down following 2015 to today. And almost during COVID, there were none put in place, right? So if you look at the average age of the rail fleet today and the locomotive fleet, it's over 25 years, which is the oldest it's ever been. There's also another element to this, which is environmental. And California is looking at the emissions profile of the rail sector and going to push them probably to do Tier 4 emission or even electric rail. And rail has sort of missed out on this environmental aspect because everyone looks at trucks and says they pollute more than rail. But the trucking industry has really started to clean itself up from that perspective, and I think rail is going to follow. So we really like Wabtec because we see a big, long runway of demand for a refurbished locomotives or even an upgrade across the fleet.
You also like Alcoa, the big aluminum maker, a company and a stock that doesn't seem to get the attention that it used to do. For years, it used to kick off earnings season. It doesn't seem to be in the spotlight as often anymore. It's off some 28% so far this year, and you like it where it's trading right now.
Yeah, and that's, 28%, that's actually off the bottom. And you're right. This was a company that got a lot of attention in the past. They've done a lot to restructure the business. Aluminum's not an industry that people really love per se. They prefer the mining industry more of, say, copper that seems to be tighter. But in our view, Alcoa has done a lot to really fix their business. One is to get the leverage way down. One is to get further down on the cost curve. And I think there's more to come. Also, what we got recently was a lot of clarity, and I think this is something that's very important to watch for investors, is clarity around the Inflation Reduction Act, specific elements of that, which the market's really been waiting on for over a year. The administration has finally started to lay out definitive rules on what tax credits will look like, how assets need to be managed appropriately to get those credits. And the aluminum industry was named a critical mineral by the Biden administration it was 2 weeks ago at this point, and that allows them to get a 10% production tax credit on U.S. aluminum production. So there's a lot of interesting things here, and we, as value investors, like to dig in corners of the market where people aren't really paying attention.